We're back with our Trader Talk segment, and today, as always, we're going to have Tech Trader here on our Tuesday segment. Good morning, Sean. How are you?
I'm good.
Oh, don't, feel free to elaborate. You're just good? Just
okay,
good?
no, I mean, this has been a fantastic year. So all I'm pretty much trying to do week after week is just keep adding to a fantastic year. But even better, Brooks Koepka won his fourth major. I'm telling you, I wouldn't be surprised if he actually makes a run at Jack's record as opposed to Tiger. I think Tiger might have won his last major. In fact, I'm surprised he won it. I'm glad he won it because I hate to it would have been a shame for him not to at least win one more. So on to movies. John Wick #3 coming out, going to be awesome. Going to be infinitely better than any Star Wars movie.
All right, okay. Well, let's change the channel from the golf channel in the Star Wars hater.
The Infinity War, whatever it was called, the end of the Marvel the cinematic universe, so to speak, ended spectacularly. So yeah, it's been a good run, both in movies and golf and in the market.
All right. Well, let's get back on track and talk about the market here. All right. So last time we were on here, you told me the correction was over. I'm not sure I'm in 100% agreement with that yet. And with that said, I want to know what you think. Do you think we're just setting up, ready to reload to the upside, or are you changing your tune a little bit?
No, well, aside from a Trump tweet, we were starting to fly again, and again, I think I'll have a full. I had a pretty full note answering a question about LITE, and we can talk about all these 5G names, but we were just due. The issue with this market, I think it's a lot like '99. People forget in '99 we had very sharp, vicious, short-term sell-offs that for people who were like levered up on margin were devastating, right? There were 5-10% corrections there were 5-10% corrections. Most of the 5 were close to 10% or over 10%. One was like 10 to 15, like closer to 15 than 10. And the difference, though, is the indices would drop 10%, and a lot of individual stocks would drop 20 to 35% during those 10% corrections. Guess what? That's pretty much what we just saw. We had a 550-point NASDAQ decline. We saw lots of stocks drop way more than 5%, right? It was about a 6.5 to 7% NASDAQ correction. The S&P was probably down about 1% less. But yeah, there were tons of stocks that dropped 2, 3, 4, 5x what the indices dropped. And then we just got, this big fear story on, China trade, which again, I would argue, and I think I'd stated that I think there'd been too much optimism baked in. In fact, it was part of my correction call of like literally 2 weeks ago, that I think there'd been too much optimism baked into China trade, sort of stocks going up on China trade, when in fact, we're probably a fair way from a deal, like a firm deal. So then we get, then you always have to assess new news. There's a lot of noise. There's a lot of news that's noise, but every now and then there's news that's very impactful. And hey, Huawei to China is probably the equivalent. Okay, we don't have 5 apples in this country. If we had 5 apples, or said another way, if Apple was 3 to 5 times the size it is, Huawei to China it would be the equivalent of like 3 to 5 apples for us. So a direct attack on the single largest tech company in China, which literally is part of almost the whole technology universe of China. They do 55 to 65% of the upgrades for the China telecom networks, which are largely wireless networks. The whole country runs on wireless networks. They don't have a big backhaul. They don't have, they don't have the fiber optic network like we do in this country. It's a deeply, deeply rooted and embedded company. And if people think it's just Android phones, they have no clue. They built their business on copying Cisco routers, literally bolt for bolt, rivet for rivet, and manual for manual. They used to ship the Cisco manual, operating manual, with the routers. So they built a business on routers. They still have they're probably the second largest router company in the world. They have a huge switching business. They have a huge chip business. And so again, it's like 3 to 5 apples. We don't have 3 to 5 apples. We have one. Well, China has one Huawei, and a direct attack on Huawei is significantly new news. Now, this is game theory to the max. We could spend the whole next 35 minutes talking about, puts and takes and game theory on Huawei. I don't think we need to do that. The main question is, it's probably mostly trade negotiation, but it increases the risk short term to the suppliers, to them. The U.S. isn't a major supplier. There's been plenty of things posted on. In fact, I was going to post an exposure list, but there's been a ton of stuff already kind of posted on that. Already, you can look, but so everybody goes from 0 to 100, pukes up 5G and fiber optic stocks on exposure to Huawei, even though for many of them it's literally 1 to 6% of their revenues. And here's the key point: nothing with Huawei will change total global end market demand long term. So if Huawei ceased to exist, that doesn't change the total amount of phones that will need to be bought, doesn't change the total amount of equipment that needs to be upgraded in networks, et cetera, et cetera, et cetera. It literally does not change global end market demand at all. It does change the timing of vendor shipments and vendor purchases, and it changes how fast the Chinese will be able to upgrade. Arguably they're the second largest 5G market. Again, they're not the second largest for most U.S. companies. They're probably in the top 5 to top 10 for most of them. But they're the second largest global 5G network. Again, it's largely surfaced or largely funneled by and serviced by Chinese vendors. So, but there is pretty good amount of U.S. sales into it. So, I'll kind of stop there. You can fire some stuff away, but again, doesn't change global end market demand. Doesn't change. I don't think it changes the valuation of the stocks, but it definitely shakes things up in the short term. It increases short-term risks, here's the good news. I think short term, I think it raises the stakes almost exponentially to try to get a trade deal done. Because, this is, again, there was somebody that wrote, a lot of times some people write hyperbolic stuff. I can't remember what analyst, but the analyst basically said, this was sort of the nuclear option in the trade deal. I would agree with that. It's a very extreme, position to take. I'm not 100% sure I agree with it, but look, I'm not in the White House. So, and I do like most of what Trump has done, re-China trade, because again, no president before has really tried to equalize our trading partnership and make trade a lot better and protect companies from having intellectual property stolen, which has been a huge problem for 2 decades or more. But it increases short-term, I would say, fear. It increases short-term uncertainty. But again, I think it raises the stakes and probably puts more attention on, risk to markets, how expensive certain segments of the market are, et cetera, et cetera. And again, I think if there's ultimately good news, is that, it probably pushes for a trade deal sooner than later, because the way things were going, as long as the markets were going up, they could kind of tease a trade deal every 60 days and kind of do one whenever they felt like doing one. Now, when you raise the stakes this much, it kind of almost forces either a yes or a no to certain things. But pretty interesting. It gave some pretty good entries on a few of these names. I think Baidu's also kind of been caught up. I mean, I was just looking at I think you asked me a question about Alibaba a couple weeks ago. I want to say the stock was like 180 to 190. Might even been close to interim highs. I mean, that they've taken 35 points out of Alibaba, and I'm pretty sure their last report was pretty darn good. So, I was looking at SINA, not SINA the chip company, but SINA the China company, SINA of China, SINA. I mean, I think the last time I was looking at the stock, and I do valuation work on this name, it was starting to look pretty appealing between like 62 and 67. You're 66, around there, you're kind of sniffing 2017 lows. Well, yeah, early 2017 lows. The 2016 lows were nuts. Would have been a huge. I mean, that was a 3xer off 2016 lows. Guess what? Stock's not. I mean, it's still a few points away, but it's only about 10 to 12 points off of 16 lows now. Now, I'm not going to do anything on SINA because I'd rather just keep nibbling on either hold or nibble or increase or trade Baidu more because I think Baidu is a vastly superior name. But I mean, again, I was looking at SINA as a potentially kind of very, very kind of value to deep value kind of name. I don't know. I'd say 60. I mean, I all things being equal, I mean, SINA at 60 would be a really good buy. But given sort of the complete and total buyer strike that I think we're seeing on Chinese equities right now, it's easy for these stocks to have almost like a free fire zone on the short side in the short term. So, but yeah, I mean, it's not, there's lots of companies going down. HUYA I've looked at before, HUYA, that's gotten very cheap again. That stock has a tendency to rip when it turns hard. IQ, which Baidu owns a big chunk of, in fact, they own 50% of it or more. Again, they had a huge rip, went from like 15 to almost 30. They're back into the 19s. So it's almost hard to find a Chinese name that hasn't gone down, 20 to 35%. So, so whether it's China, whether it's stuff related to Huawei, I would say that, that probably makes upside in the market maybe a little harder to attain. But again, I mean, we had that big NASDAQ correction. I don't know. I would say, from a market perspective, I'm really not looking for. I mean, I'm not set up or not necessarily positioned or looking for a correction. I mean, I got a lot of cash, but I'm not like I don't feel like right here, right now. I wouldn't feel the need to increase shorts much. Again, unless we get almost what I said. If we get almost like a panic buying period. A panic buying period of a couple days with these cloud stocks, which haven't really come in much, then I might look to increase some shorts in that stuff. But as far as like thinking that I need to put on index shorts, I mean, again, I was shorting some index-based instruments a while ago. They're a lot closer to recent lows than recent highs. So I tend to short at higher prices and then cover lower. I don't tend to short into way into the hole. Just like I don't tend to buy stocks at high prices and hope they go higher. I tend to buy stocks at very, very low prices. And sometimes they go lower, but I buy low and I intend to sell at much higher prices. So I don't buy high and hope stuff goes higher. I basically short the same way.
All right, and let's make sure that we remind everyone that you are definitely among the longer-term type holders when it comes to these. You're more of a long-term value contrarian value, if you will, trying to find value in some of these tech names, which is pretty hard to do, and your holding periods last what? I mean, anywhere from, I know you will take some shorter term trades, but on average, I mean, you're looking for a couple of quarters, 6 to 8 quarters out, if that's like a fair way to assess.
Yeah, I would say, I mean, I think I've posted something like 30 to 35 profitable trades this year, which again, it's not really, that's not my core game. But I mean, if somebody would go back and look, and I've got at least 25 closed profitable trades, and I'm not doing trades for 1 to 3%. I mean, I typically don't even take a trade unless it's 7 to 10, 15%. And again, it might be as many as 30, 35 closed, relatively shorter term trades. But yeah, I mean, I'm looking out. I'd say a 2-quarter hold for me is pretty short. I'd say 1 to 2 years is sort of normal, and I've held stocks for many years. I mean, I've held at least some Twitter since its IPO. So now there's been periods of time where I've sold most of it. There've been periods of time where I've effectively been net short the name. But I've literally been long Twitter from the first day of trading. So, that's an example of how long my holding period can be. I've had two times in my life where I've held Apple for at least 4 to 5 years, maybe even longer. So yeah, I mean, I can hold stocks for quite some time. But I think the key thing too is that where was I going with this? As opposed to, I just don't get that concerned. I mean, if you're trading tech and you're trading biotech and you're trading energy, those 3 areas specifically, if you're trying to put, we've talked about my stop strategy, which I don't really use a traditional stop strategy, at least for the stuff I post on briefing, because the short-term stuff, if I'm doing a big intraday trade, I might have a tight stop. But you literally are going to get stopped out of pretty much every single investment you have in tech if it's 5 to 7%. I mean, if I look at a period, for example, 2013. So this would be a really good, I think this is worth talking about for a couple minutes, because this would be very similar to my BIDU long right now. In 2013, so I had completely exited Apple. I was on my prior subscription company I was with, a couple different ones. I was literally the biggest and longest running Apple bull on a couple different sites. And I mean, we're talking literally from 08, 09, right? So this is 2012. I pretty much exited my Apple long, missed maybe a quarter or two of upside, but pretty much called the move. I'm like, look, there's no large screen phones, there's no this, there's no that. I wasn't a Tim Cook hater, I was an Apple hater. I just thought the stock got way out ahead of itself. So circa 2013, I start nibbling on Apple a little bit, just a little bit. Probably my first buys were between 480 and 500. Can't remember exactly, but somewhere in that range. Apple didn't bottom until 382. Didn't take that long. Probably took about a quarter from when I started buying it, maybe 2 quarters, but I think it took about a quarter. But yeah, I mean, at one point I was down 100 points on Apple. Again, that's all split adjusted. But back then the stock had come off of, I think, 700 and change, and at the 2012 highs. So I had zero concern when it was down 10-15%. I had zero concern when it was down 20. I mean, I literally wanted it to go lower. When it was 385, I wanted it to go to 355. It never did, but I wanted it to. So needless to say, I ended up making, because I kind of thought, okay, best case, I'm going to catch Apple here around 450. Because at the time, I think it would have been about a 35% decline from highs. Apple ended up losing half of its value from the high in 2012 to the low 2013. And I'll remind people, it had literally the best balance sheet on the planet. There was no company that had a better balance sheet on the planet. And it was, in fact, had a way better balance sheet than it has right now, because there was no debt on it. It was all net cash. It was trading like it somewhere. I can't remember. I wish I could remember I used to have notes again. I actually looked through my computer. I can't find them. But it was somewhere between 2.5 and 3 times net cash. I think it was closer to 3 times net cash. As of the low yesterday, Baidu's trading at like 1.7 to 1.8 times net cash. Now, is Baidu Apple? Probably not. But you know what I'd say? I think Baidu today is probably pretty similar to Apple 2013. I don't think they're that. Apple's just bigger and more dominant and has a larger moat now. At the same time, they don't have much growth now. Where in 2013, I hit it 100%. I had a correct view that Apple would actually retake a ton of share that they lost to Android, which is exactly what happened when they started making large screen phones. So circle back to today. If I'm down 20-25% on a stock that I intend to hold a couple years, am I going to say am I going to bet like jumping on the bed celebrating down 25%? Probably not. But at the same time, the part of me wants the stock, doesn't mind at all that the stock's lower. I bought more yesterday. You know, again, I don't really mind that if a stock I really like goes lower. I'll close the loop with this. Warren Buffett's never used a stop, and Warren Buffett has always maintained, if you really like a stock, you should want it to go lower for a while, until, you know, before it starts going up, because it allows you time to look at it, assess it, calibrate how big of a position you want it. It also gives you time to build a position. You know, you don't have to be in a rush to build the position super fast, which, by the way, that can be a huge mistake. So it gives you a time to see if the stock is going to base out. So yeah, I mean, if there are people out there that have anxiety about BIDU, then, you know, one, you should never read one of my comments as a standalone comment, i.e. read my comment the day of earnings and as the first and only comment you read. You should read my comments on a stock for at least, I'd say at least, I mean, literally, I don't post a ton of times a day. You know, you could read all my comments I've posted on BIDU for 6 months in probably less than 4 minutes. So I would suggest anybody reading my work, if you're reading a particular ticker symbol, read my symbol under TECHT for my prior to at least 2 or 3 quarters. Again, it probably takes 3 minutes at most. Type in the ticker, put it in, so you skim everybody else's post, read my post. You'll get a very clear view on my thesis on the stock. But yeah, no, I mean, I literally am not a bit concerned about BIDU, and it feels very similar to Apple in 2013. There's only one major change. It's way cheaper. You know, I probably would have gotten way, in fact, I probably would have gotten way too big in Apple had Apple literally traded at 1.8, 1.9 times net cash. I probably would have done something like put almost all of my net worth in Apple. And again, that would have been a mistake. Even though I would have hit it huge, the problem is I probably would have sold too much too soon, because when you own too much of something, it's easy to take the first 20, 30% move. It's also easy to miss a ton of trades and lots of other names. And I had a massive trading year in 2013 with just tons of names worked that year. Pretty much everything in small and mid cap finally accelerated, went nuts in 2013. So yeah, it would have been a mistake unless I would have kept literally all the Apple for like 5 years, which is really tough to do when you're a trader and you have to live on trading gains. So bottom line, hey, I think, put it this way, it's not Apple, because I mean, I would have said Apple literally was one of the 2 best technology companies in the world in 2013. I don't think BIDU is one of the 2 best technology companies in the world, but it is one of the 2 best technology companies in China, which isn't bad. And again, it's trading close to a 50% discount. It's probably like a 40% discount to Apple's cheapest price in the last like decade or 2. That's a pretty good price. So again, I'm just not going to be that concerned. Now that doesn't mean that yesterday's the low. I don't know where the low is. Stocks do weird things. Algos have a ton of pressure. They can exert a ton of pressure. I don't know if the stock goes up a ton. Until I think a move to 135 or something could happen relatively quick. In fact, that I guess I'll mention that. You know, I mean, this thing's a catalyst away from a 10 or 15 or 20 point move higher. Again, that probably fades, but I don't think it would take much good news for the stock to basically get. I mean, it was trading 134 or 135 after hours after the report. So, you know, anyway, I've kind of got markers. I've got a lot of trading markers. I like the 134 level, 128, 123. You know, I can use yesterday's low as a marker. So I've got plenty of places to put trades on. And in the meantime, I'm just going to try to trade this thing and not try. I'm just going to trade it, do a lot of trades short term. And, you know, it'd be pretty easy for me to make back, you know, the points I'm down in it. I mean, I'm not like, that was what was really easy too back then on Apple. It was that, you know, it took a little while. It took a little while to kind of build a base. It took a little while to kind of, to mark a firm low. And then I'm trying to think, the first good catalyst I caught was an Icon investment in Apple. And that was good for probably a move to like close to 500. So like, I think it was about a 80 point move. Again, sounds big. It was 20%. It was a 20% move. So, that's probably going to be, you get the first good catalyst for BIDU, you're probably going to get a 20% move higher. So again, I just, like I say, I'm just not, I'm not going to share the anxiety that some people have posted on the name, because for me to be down 25 to 30% on a tech stock is just not a big deal. That's how much they can move. I mean, I've had good tech stocks that I've made huge amounts of money on, and I've had those stocks drop 25 to 30% after hours. So, tech, biotech, and energy can move a lot. So if you're going to trade those groups, you better be prepared for moves of 50% or so in relatively short periods of time.
All right. Does there ever come a point that you can envision where the drawdown would just be too much in BIDU that you would just pull the plug?
I guess I'd have to see. It's if the drawdown came with some sort of deterioration in the business that I didn't see was recoverable, then sure,
But not really a price, right?
I don't think so. Because if I change my view and all of a sudden say, okay, I'm going to trade this one name differently than I've traded every name for the last 20 years, then that's changing my process. Why would I change my process? So I just don't. I'm not going to change my process. Everybody else is free to whatever processes and disciplines they have, but I'm going to keep the processes and disciplines that I have. So yeah, no, I don't really, I'm not, if I was worried about the balance sheet or something, well, one, I don't even know if I have it in the first place, because it's the only China stock I own. And again, I was looking at SINA. I mean, I haven't owned SINA for a few years, but it's probably about the same price. I want to say I owned SINA around 45 before, and that was good. I didn't get a two-bagger on it, but I made, 60 to 100% on it. But yeah, I do a lot of balance sheet work, and I do, a lot of fundamental work. And, you hear these things, there was, I think, some analyst, by the way, I think an analyst who literally had a $350 to $400 target on BIDU 3 or 4 years ago, now is worried about core BIDU and operating profits in core BIDU and da-da-da-da. It's like, okay, well, why should I believe that guy now when he's kind of just reiterating what the company reiterated on their call, but making it into a worse case? Why should I believe that guy when he thought the stock was worth 400 4 years ago when I didn't like the stock? Again, so I wasn't buying BIDU at 270. Where you start buying a position is hugely important. I feel like my prices on BIDU are pretty damn good. So it doesn't mean I even said I don't know if I'm buying. I don't know if I'm buying the low on any stock. But yeah, I didn't like BIDU at 280. I wasn't buying BIDU at 280. I cleared out of Apple in 2012, and I wasn't buying at the highs. So then I didn't have to deal with the position that was down 50%, and probably didn't have any money to buy it with. So it's a way better position. I guess here's the last thing I'm going to say. I'm not going to get every name right. I'm just not. But I'm trying to think of, since I joined Briefing, has there been a high quality stock that I had investment position in that I missed? I don't know if I can think of one. So just look, just read my stuff. I honestly, I think any question of my record has been answered 20 times to the good. So I'm just not really going to worry about my historical results because I've got plenty of good. FireEye might be the only position that I can. By the way, I had FireEye before I joined Briefing, so might be the only position I end up long-term investment position for literally last half decade that I ended up taking a loss on. The last investment position I had I took a loss on was Fusion.io, and that was in 2013. So I'll take plenty of trading losses. Again, you guys have plenty of short-term traders. I don't join the short-term trading fray because you guys have plenty of short-term traders. But like I say, the other thing I think this is very important. I caught a lot of heat on Nutanix, man. I don't know if you remember that. I caught a lot of heat on Twilio. Honestly, I think all the negative heat I was catching on Twilio actually impacted my results. I think because that position came very good. I was buying it low to mid 20s, and and caught close to a double on it. But just think about that. So I was selling it between 45 and 55. I missed 100 points. Well, I wouldn't own it today because it's past the valuation parameters that I like. But I definitely could have owned it for another double, and I didn't. I actually think I let a little bit of the negativity seep into my brain. It didn't affect me at all on Nutanix because I literally did. I bought tons of Nutanix. I kept buying that on the way down. I mean, there was a peer. I mean, I felt like I was facing hatred from the people who were unhappy on that name, and yet it didn't affect me at all. Like say, I kept a large part of that position for a triple for my cost, and I didn't really want to own it much more above 45.50. I am re-engaged with the name now. I started liking it again in the low mid 30s. But again, I wouldn't have kept Nutanix to 60 because pretty much at 45.50ish, it kind of was full value for me. But I tell you what, I think I kind of got swayed. I think I got swayed on Twilio. By the way, so that's a good lesson. I typically, outside factors don't really influence me very much. And I can't say it consciously influenced me, but you never know. There can be all sorts of things that influence your subconscious. And I don't know. It was just weird. It's weird for me. Again, I hit Mule to the buyout. I hit a lot of these other cloud names that I was long. Again, when nobody else was long them, I carried quite a few of those to pretty good gains. I sold Twilio way too low. So I don't know. I have to think about things like that. Like I try to improve. I kind of try to constantly iterate and improve, and I definitely feel I get better at this every year. And I think Twilio was a good lesson. I think I just sold it because it felt so good selling it at plus 50, plus 75, plus 100. And I don't think I sold it per my disciplines because I still had plenty of... By the way, I kept it on my focus list for a long time after I personally exited the position. It probably remained on my focus list until it was probably 105, $110 stock. I'd have to go back and look and see when Twilio was in the last focus list before it got removed. But, again, kept it in the focus list for a long time. I liked the position. I hope other people did way better on it than me. But anyway, so in other words, why would I make a special circumstance for BIDU? I'm not going to change my process. So, here's what I do, Jim. I don't sell stuff because of price. But there's plenty of times I sell things. So if I feel like if something happens and the setup comes to be such that I feel like I need to sell BIDU, I'll sell it. It's not a big deal. I'm not afraid to sell stocks, sell them all the time. But like I say, I'm not going to sell because of price. Good example. I was net long through 2008. It felt painful for certain weeks at a time. I did reduce my position. I did reduce my net long. But, I never went net short in 2008. Can't say it really hurt me. I had all my money back and more by late 2009, early 2010. So if I'm not going to close out every long in 2008, why would I do it now? We're not in that kind of market. So, but yeah, I like to say I'm just not that concerned about it. In fact, my mode now is to keep all of it that I have and start adding trading gains to it. That's my mode. My goal now is I'll probably try to create 30 to 50 points of trading gains. But I'm not going to push it. I'll let them come when they come. But I think the stock's basically basing. And by the way, too, no one stock is going to dictate success or failure to me. That's why I trade 15 to 20 positions. That's why I own 15 to 20 plus positions. I'm pretty good about keeping my largest positions are all roughly the same weight. So no one position is gonna make me a hero or gonna blow up my account.
All right, so let's talk a little bit about your just overall portfolio makeup, just so people get a context of this. Would you say your overall portfolio strategy is all tech, value tech, or do you diversify somewhat?
Well, I do have a concentrated portfolio because I specialize in basically three sectors, kind of as I talked about: tech, biotech, energy, and then I've had huge weightings in financials at times in the past. I have very small weight in financials right now. I do like the financials, but I don't know. There's more things I find more attractive. So yeah, I have a concentrated portfolio largely to tech, biotech, and energy. That's kind of where that's pretty much what I'm always going to be, because those are the areas I focus on. And what I do is I kind of, you've seen me call a lot of corrections. You've seen me put on a lot of shorts. So if I feel like I'm facing risk, I'll hedge. I'll do hedges. I'll put on short trades. I'll try to make money on the short side. I'll reduce market exposure. I'll also sell. I'll also trim total exposure. I won't necessarily trim one name. I won't single a name out. I might just sell 10, 20% everything across the board on any given day if I feel like doing it. But yeah, that's for me. If I'm worried about downside, I kind of do what I just did a few weeks ago. I was very vocal about a correction coming and positioning for it and putting on shorts for it. So I think I manage downside pretty well. I tend to be more of a long-term investor. So long, that's the other thing. It's hard to catch. It's easy to catch 15 to 20% returns and have sort of a view of like, okay, I'm going to really kind of try to control my drawdown risk. However, it's pretty much impossible to own a stock for multiple years, which means you're going to own it through multiple earnings reports, and you're going to take the good ones and the bad ones. It's almost impossible to get 2, 3, 4, or multi-bagger return if you don't accept the risk of print risk. There's just no way. I defy anybody to say, yeah, I made an 8-bagger on Apple, but I avoided every single earnings report. There's no way. So, because you're selling it and you're reinstituting a fresh cost every time. And by the way, the stocks do go up the most after big earnings beats. So if you miss the big beat, yeah, if you avoid the downside, that feels good at the time. But then if you miss the 2 or 3 huge reports that cause the stock to gap and go, you're going to be buying that thing way higher. So, and again, hey, I'm not telling everybody what they should be doing. I am telling people what I'm doing. We're not financial advisors. People go hire those on their own. We're sharing our own personal experience. People are free. If it fits in with what people are doing, it fits in with their mindset and how they want to, they think it's helpful, great. There's tons of guys on the platform that are providing tons of different feedback from all different. Hey, there's guys I probably love personally. I literally never do some of their trades because I don't buy high and hope to sell higher. That's not my game. But you can be a very good momentum trader and make money doing that. That's not my game.
All right, let's get a quick update on some of your names and holdings, some of the more popular ones. Let's talk about LITE. This one's been a big mover over the last few days based on some of the Huawei news. What's your take on this?
Yeah, I think it's back to buyable range in here. I was kind of hoping we would get. I was kind of hoping we maybe would. I just didn't think when I was buying that at 4180 a few weeks ago. At the time, I literally didn't think. I wasn't sure we'd see that price again this year, and I probably should have kept it a little longer. But again, I don't feel like I got to own all these names all the time. I've got big exposure to the 5G space holistically. So some positions I'm going to have more of a trading view. I have more of a trading view on LITE just because I got stakes in like 4 or 5 other names. So I kind of don't need to double up on exposure that's relatively equal. But yeah, no, I think it's back in a pretty good buy zone. I am long some here short term. I've been nibbling at it. This is a name like, say, I'm not going to look to ride it to highs. If it gets a move back to 52, 55, I'll probably be gone. Something like that. Depends how fast. If it were to just kind of go nuts and at the end of the day today was at 50, I might just exit the whole thing, because it's like a good 2-day trade. But I think it's going to take a little longer. Honestly, I think this Huawei news is going to have some life. I think it's going to have some pulse. I think it's going to kind of heat up, quiet down. So I actually think it could be pretty good for trading, to be honest, because I think if you have my view, which is global end market demand is not going to change over a multi-year period because of Huawei, but short-term risks are highlighted. That could give you these flash 1 to 2 day sell-offs. And I plan on buying into them. It doesn't mean I'm going to buy into every one with every name, but I'm going to selectively buy into them. And but yeah, I think anything 45 to 48, I think is a pretty good buy zone. And anything under 45 on LITE, I think is getting really good. I mean, I would even say 40. Some guy asked me about support. I said, I think 42 would be incredible support. I don't. That doesn't mean the stock's not going to go below that. I just think that sometimes support is the price at which you hit, where it doesn't so much matter how much lower it goes. What matters is the first piece of decent news you get, the stock surges above that level. And that's usually what I try to identify. So I'd say 45 to 45 or 42 to 45 is that zone for LITE. Meaning, it doesn't mean, hey, could they go to 38? Sure. If the news got bad enough, something weird, if Apple got it down again, 3D sensing stuff got it down again, I suppose, right? It could go lower, but then I think whatever the next piece of good news is, you probably get to move back up through 42, 45 and above. So that's an area there. Again, I think I was hoping for 42. I think pre-market. What was the pre-market low yesterday? By the way, the stock. This is another thing I watch for. LITE never traded at the pre-market low yesterday. So the pre-market low, I think, was a full $2 lower than the regular session. Regular session didn't even sniff the. By the way, IIVI was the same. I think the pre-market low was a good. Let me look. What was the low mark? Well, maybe IIVI kind of sniffed it I don't know if you literally kind of got a fill there though. I'm showing that there is a tick down to 31 yesterday. I would be surprised if anybody got a buy order filled there. That was probably a stop sell that got filled. So there again, you look where the stock closed. The stock closed literally 10% above the low yesterday. So I don't know. It's possible that some of the pre-market lows or the first print lows we saw yesterday. I don't know. Those are put it this way. I'd definitely put a list if you like these stocks. I'd put those stocks. I'd put the pre-market or yesterday low on a sheet or on a spreadsheet or something. And I think you get prices close to those. I think you can trade against those pretty effectively.
Real quick, so when you talk about a tradable range or a buyable range, in this case LITE is the one I'm looking at, what type of percentage would you do? Like, would it be, I know sometimes you say chip away, but in terms of scope for our listeners, is that, say, 1/4%? Is that an eighth of a unit size? What type of size would you do?
Yeah, I'll just talk because I think talking percent of portfolio. Everybody has to do what they feel comfortable doing. For me, I would say anywhere from sort of an eighth to a quarter of an intended position. So if I want to think of, hey, 8/8 is a full position for me. If I'm saying I'm chipping away, it's anywhere from an eighth to a quarter of a position size for me. Although sometimes when I put on a short-term trade, it's actually like the trading size is maybe the size of a full investment position. So honestly, it just kind of depends what I think the setup is. So I don't know if I have I definitely have processes, disciplines, pretty hardwired. I give myself a fair amount of flexibility on short-term trading size. Because sometimes you just get a crazy price dislocation, and you might get a trading entry that you feel like you're going to go fairly big into. So yeah, I don't know if I really have a good answer on that, but I think in typical things, standard kind of what do you want to call it? Normal operating procedure. Quarters, thirds, things like that of a position size. Of a full position is probably kind of my own good rule of thumb.
All right, and then let's just real quick back to BIDU.
By the way, let me add one thing. Actually, when I'm building a position, I'm likely to have a lot more buys. If I'm trading something, I don't really view a trade is something I'm going to build much. So usually if I'm trading something, I'll take one or two pieces. That's my trade. And if I either catch it at the price, I either catch it at a good price or I don't. Doesn't mean my price doesn't work. By the way, I think I posted about, I don't know, I think my last lift trade was low 51s. It went below, but that's working pretty good now. So yeah, when I do a trade, it's usually a distinct. I might add one time to a trade. I've added 8, 10, 15, 20 times to a position. But if I'm doing a trade, I'm typically putting kind of a line in the sand and buying something, one or two times for that trading size. And then I usually have a multi-day to a multi-week kind of exit in mind. And again, if it's a short-term trade, it's probably hours to days. It's not multiple weeks. Oh. Again, I don't really post it. I don't really post a ton of trades. I don't post. I don't have time. I don't have the same arrangement at briefing as a lot of the other guys have. So I don't, i.e. I'm not full time for briefing. So I'm full time trading my own account. That's how I make my living. So I don't. You're kind of asking me questions about stuff I really don't post much on. Like I don't post much on short term trades on briefing, and I don't think I intend to.
No, actually, I didn't want to get into discussion in some of that in the short term stuff. In fact, I
misunderstood. Yeah, the only stuff I really post on briefing. I have posted, I don't know, hundreds of trades over 3 years, but the bulk of what I'm posting, I'd say 80% of my content is position theses, individual valuation theses, and position building and position exits. I mean, I'd say that's 80-85% of what I do. So yeah. So
and that's really what I wanted to focus on in terms of
so the answer to that question is the typical size is typically anywhere from a quarter to a third would be big ads, and a tenth to an eighth would be small ads.
Okay. So yeah. And hopefully.
But here's one thing I'm going to stress: once I have a position relatively full, like I get a lot of times people say, "Hey, you adding? Hey, you adding? Hey, you adding?" I think what they want to hear is, yeah, go ahead and do it. But again, I only post what I'm doing, because again, we're not advisors. So if I have a relatively full position, I might not really add much anymore. I have quite a bit of room. I could add BIDU quite a bit more. So I don't have a full. Then I also give myself the discretion if I want to go overweight. I can go overweight. Usually my overweighted positions are due to price appreciation. An overweight is very rarely because I bought into an overweight. It's usually I bought something full, close to 2/3 full. A 2/3 full position that goes up 200% ends up being like a double overweight if you don't trim it at all. And sometimes I will buy. I mean, I'll tell you what, I heavily overweighted Apple in 2013. And I bought into that overweight, and then I was almost forced, like literally making myself sell just to not so it wasn't so crazy of a weighting in my position. That's the largest I've ever been in any one position was my Apple position in 2013. I've never been as big as that since. I may have had a similar Google position size years, but like 05, 06. But I think I've only done that like twice in my life.
All right, and then last one.
I don't think it's a good habit. I don't think it's a good habit of trying to, make all your money from home runs. Because it's just it's like baseball. It's just way easier to hit. You can hit hundreds or thousands of singles and doubles and triples, and then a good hit could become a home run, right? Whereas if you're trying to make or break yourself on feast or famine 50%, 100% positions, that's a tough existence. So at least for me, maybe there's a few people out there it works for. I would have a hard. Now that's where I would get emotionally uncomfortable. I think the key to all this, I've been super relaxed all year. You know when I was tense? I was fairly tense on December 24th. But I executed my plan, did every single thing I wanted to do. But I was pretty tense. I probably slept the worst I've slept in 2 years from December 23rd through December 27th. But, once we're kind of on the backside of December 27th, started sleeping a lot better. That was pretty damn tense. Nothing right now is very tense. I had just a blowout, awesome first 4 months of the year. So really everything from this point is pretty easy. I'm just looking to add incremental value, looking to have a position like a BIDU, which I can scale into, which becomes a new multi-year holding position, which becomes a winner. But as I wrote, I took a lot of stuff down. This year is playing out very similar to last year, and that there was a huge Q1 that I took really good advantage of. And so from this point forward, the last thing I'm going to do is get super aggressive and basically wreck a year, which has already been made. So everything else is sort of trading around the margin, basically. By the way, one thing I will say, I don't think this is a great time to be super aggressive on really anything. Market's still pretty high. We've had some nice sell-offs. We've had some corrective phases. The 5G group is back to pretty nice, pretty buyable levels again. But, the higher the cloud, here's the same situation as we had last year. When other stocks were dropping but FANG wasn't, you still had the same amount of risk for everything. Because the higher FANG meant the more risk, total market risk existed. Because until FANG corrected, you hadn't de-risked the market. You hadn't de-risked indices. We have the same market today. We don't. It's instead of FANG, it's cloud. So as long as the cloud stocks are trading at these lunatic high valuations, that we actually have a lot of market risk. Because until the clouds correct enough and de-risk, then the whole system has that risk embedded in it. So until the clouds have a relatively large to maybe massive correction, I view this market as pretty risky. It's a lot riskier than but put it this way, it's probably 5 times riskier than it was in late December when I was free. When I was basically buying with everything I could. Or holding. I was holding everything I could. I was adding stuff. I didn't sell a thing in November and December. It's a totally different market. It's a way riskier market. That doesn't mean we couldn't go up a lot. That doesn't mean we can't. This quarter, look how many companies still had a bunch of great earnings reports. But, until the clouds rectify, until the overvaluation of clouds rectify, we've morphed into the exact same market risk position we had, from June to the end of last year. It's same deal.
All right, and then the last one I'm going to talk about here is Bloom Energy BE. This one's pulled back a little bit. Are you interested in adding to this or sitting tight? Here
everything's relative to everything else. So I'd probably rather buy. Effectively, BIDU is a $12 stock too, right? So BIDU is a $16 stock that went to $12. Bloom is a $12 stock. I'd probably rather add to BIDU. I'd probably rather add to LITE. Probably rather add to IIVI.
But wouldn't this diversify you a little bit?
Yeah, but that's not something I don't run a portfolio to try to emulate the diversification of the S&P 500. So, even though I can own things for long periods of time, if I want to, I can hit a button and I can close everything in 3 seconds if I felt the need to. I'm not saying I'm going to do that. I don't know if I've ever done that. There were some periods of time where I've sold 35 to 50% of my account in less than 3 seconds. I can't think it hasn't happened for a while, but I've done that multiple times. But yeah, I like it. I think it's back in a good buyable zone. I think they reported well. I think it's I think it's definitely a very intriguing, high quality growth. I mean, probably the best way to say it, I think it's a pretty mispriced high growth stock. So relative to other growth stocks, again, it's not really, it's kind of an alt energy play. I mean, there's kind of a blend of everything here. You got a little alt energy, you got tech. I mean, there's a lot of high tech in Bloom Energy, right? But it's high tech in the alternative energy space. But yeah, it's an attractive thing. But again, hey, you asked the question. I'm just telling you what I'd personally rather do.
Yeah, I was just getting perspective out there.
I personally rather buy 5G, fiber optics, BIDU. Again, if BIDU is 160 and LITE and BE is 12, I'm more attracted to BE. If IIVI is 40 and BE is 12, I'm more attracted to BE. But I do. I mean, maybe we haven't really talked about this. I think the selling of sort of everything 5G, everything fiber optic. By the way, Qualcomm. Yeah, I mean, Qualcomm's back. I think Qualcomm's back is in a buyable zone. I think I posted that. I thought 72 to 80, 72 to 82 was an area where you could start adding, or I could start possibly adding Qualcomm again. And I think I said that when the stock was closer to 90. But all of a sudden, Qualcomm $78. I think Qualcomm's a pretty good buy. So Skyworks is a very good buy again. Remember you and I talking about Skyworks and how mad I was? I missed it at 62, and you said, well, you still could have bought it at 72, and it went to 92. Mm-hmm. Well, it's back to 69. Again, I'm not sure I'm going to buy it, but I like it. So anyway, we all of a sudden, I think we had a little bit of an overshoot, maybe even a large overshoot. We had a big overreaction to Huawei. All of a sudden, everybody became an expert on the chip exposure to Huawei. And put it this way, it's almost classic when everybody on CNBC is talking about the same thing. That's usually it's too late to sell at that point, and it's not always a great buy at that moment, but it's usually getting to be a good buy. I think this is going to take a while. I think the prices that we saw yesterday, or the lows of today, we might revisit them a few times. I think we'll be able to trade sort of this Huawei sort of anxiety trade for I think at least a few weeks, if not a couple months. We'll just have to see. But I think it's a good area for trading opportunities. Again, I do like BE. I mean, you know me, dude. There's times. I mean, somebody asked me about ACAD, and I don't have interest. All of a sudden, 3 weeks later, I buy it. Right? So it kind of just depends how things line up, charts line up, how other stacks are acting versus other names. The last one I'd mention, I think AMBA's back at pretty buyable levels again, and that's a name I haven't talked about for quite a while because it wasn't, I didn't really have any interest in buying it, around 50 or close to 50. But again, you take 6 points out of 7 points out of a stock. I don't think AMBA has any. I think they have relatively limited China exposure. And by the way, that's another thing. Why all of a sudden is China exposure the worst thing in the world? Wouldn't it be interesting if China exposure becomes good to have? I mean, I've seen stranger things. I mean, you get a good trade deal. I mean, here's the other thing. How long have we been talking about this trade deal? You tell me, is this a year now? Is this 6 months? It's certainly this whole year. It's for sure this whole year, but was it going on mid last year too?
Yeah, I believe so.
Okay, so put it this way. We're from today to the end of when we actually get a trade deal, we're way closer than we were 6 months ago. Doesn't mean we're going to get it, but the one thing we know is we're way closer, right? So I also like the fact that you have a lot of stocks that are de-risked. Hey, LITE was down 22 to 26% in like 4 trading days. By the way, it was down way more. I think it was down 36% from the high. Remember, I didn't like LITE at 60 to 64. I even think I thought a couple analyst grades at 58 to 60 were pretty poor. And so the bottom line though is that, hey, look, they guided down. Yeah, it was roughly a 7% guide down. They took 25% of the stock in 4 days. Okay, so we know they guided down 7%. I like those odds. Those are good odds. I haven't really looked at QRVO for a long time. Same thing. I think QRVO had about a 6-7% guide down. I don't know what you tell me that percent decline. That maybe wasn't quite as much. That was about 20-some%. Acacia is the one I'm really circling back to because, and by the way, somebody wrote in, again, probably a new reader, said Acacia, my pick Acacia was going down. Guys, you got to read back. I've been, I was buying this thing as low as 30, maybe even as low as 28. So again, you got to read. You got to do a little homework and study these positions a little bit. But the key is this stock was 61. Certainly wasn't buying it at 61. They have maybe 1-2% exposure to. I've never remember them even mentioning Huawei on a call, so it's not anywhere close to a top 10 customer. So they have roughly 1%ish, I think somebody said. This thing's gotten hammered. Sold off a little bit. It actually sold off a good chunk just in that 550 point Nasdaq decline we had, but it certainly hasn't bounced at all. And it's gotten some follow-through selling. And again, they basically don't have any Huawei exposure. Now, there are going to be some China deployments that they were in line to get pretty, a decent chunk of sales into those deployments. I guess it's possible that they could be locked out of those deployments if this news stays really bad. But they kind of have the only technology in the world that they have. There's not really. They have about a 1.5 to a 2 year lead, maybe even longer, in certain technology. So if China Telecom, China Unicom, and China Mobile want their technology embedded in their networks, it's going to be awfully tough if you can't buy components from them. So, but again, this thing's been really hammered. In fact, just in the short term, what I'm hoping for. I'd like to get a trade exit out of part of my LITE position. So let's just say LITE's 52, 53. If Acacia's still in the 48s, I'll swap that to Acacia.
All right. Well, let's leave it at that because we got a lot to digest today. That's for sure. As always, Tech Trader, thank you so much.
Well, here's the thing. I think it was good to talk about this because sometimes we get wrapped up in talking about names, and I think there's always new subscribers that come to the platform. Mm-hmm. And they have to kind of learn everybody's styles, right? So I think that sometimes it's probably good to take a step back because we kind of just keep doing. When I make a post about a stock, it might be the 60th time I've mentioned the stock in the last 6 months. So to me, it's a continuing stream of consciousness on 60 prior posts, right? Mm-hmm. But if somebody brand new reading the post, the first post, and that's all they read, they're going to get an incomplete picture. So I think it's good if we kind of, I don't know if I want to do this every third, but I'd say like 2 or 3 times a year, it's probably not a bad idea to kind of have a, I don't know, what do you want to call it, kind of a style discussion or something like that, or a disciplines discussion.
Well, that was a big purpose of what we had on the agenda today. So, as always, thank you so much. And, we'll be back next week, and we'll talk about some of these names and see how things play out. Maybe we'll have a new tweet, a new China story. Who knows?
Hey, well, we don't really know. We'll just have to see. We have to kind of react to it. But, again, I do think I think we've at least gotten back to a place where enough stocks have dropped. At least there's some stuff to go out there and buy that you don't have to chase at all-time highs if that's not your game.
All right. Good stuff as always. Thank you, Sean.
Take care.
All right.
And let me know what you think of John Wick and how much. Well, I'll just end there.
Well, considering I haven't seen John Wick 1 or John Wick 2.
Oh, my God.
All right.
Okay. Yeah, I do have to hang up now.
All right.
Yeah.
Get off my phone.
All right, later.
All right, my man. Thanks.
See ya.